welcome to At Home with Sunil Singhania, a Diwali special with me, Tanvir, Gill and Niraj Shah.
Well, both me and Tanvir take you to the house of Sunil Singhania, a man who manages 35,000 crores of equity assets.
Hi, Sunil.
Hi, Sunil. Thanks so much for joining in, please. Thanks. Sunil, when, as we said in the intro, for you, probably work is home as well, since you've been in your office so long. What we want to figure out is, what does Sunil Singhania do at work or at home besides just hardcore markets?
I think I love a lot of things. So obviously I have two kids, so they take up some time. My son is going to go to the US next year, hopefully.
Okay.
So I'm been helping him with his school a little bit. And I have a lot of friends, and I think friends are life. So weekends are with friends. So I go to the club. I used to play cricket. Now I don't, but I do go there to the club. And pastime is reading. Sometimes I play the guitar.
So it's not markets all the way.
It's not market all the way in the sense of work, but in the mind it's always markets all the way. So, the good thing about the market is something or the other is always happening. So even on weekends you have news flows coming in, you have friends who discuss and it's fun.
Yeah, but I'm sure you discussed politics the last few days, Sunil.
Politics was fun. So yesterday we all got together, and from 8 o'clock in the morning to 4 or 5 we were all together. So it was a lot of fun, doing a little bit of masti, politics, snacks. It was fun.
In fact, politics was the theme that dominated your recent note, what we're reading right now. You talked about the principles that the Modi government follows under the leadership of Narendra Modi. What do you, as Niraj and I were just discussing before the show, is that your driving principle as you approach your strategy with the markets?
See, one thing is very clear that not only in India, but everywhere in the world, politics does play a big role. And it is not about the markets, but it is definitely about the economy. And I think specifically in a country like India, which has so much potential, and somewhere that potential has not been exploited to the fullest because of whatever we have gone through in terms of policy action, it becomes all the more relevant. And I think that's the reason why most of the market investors would be looking at politics much more closely than they would say in the past.
So do you think that from this year to the next, from this Samvaat to the next, India is pretty much on track to get re-rated, because we've seen a part of the rally already play out, and this has been a great Diwali. I'm sure everybody's celebrating with a lot of gusto, given the energy and enthusiasm there is overall. And do you think that's just going to build on over the next 12 months?
Definitely. I think from our perspective, with a little bit of luck, which also is shining on India, given that we have recovered as far as the rainfall is concerned, and with the way oil prices and commodity prices are falling, we do have luck. I think we are entering into a phase which is making India stand out. I've repeated it earlier also in various forums that last 4-5 years, India was the reverse of the world. So in the world we had prices falling, inflation falling, interest rates falling. India was among the very, very few countries where interest rates were rising, inflation was rising. I think now if you see the last 10-15 days of volatility in the world was largely because of concerns that growth is slowing down, interest rates are rising. And India, on the contrary, we have wholesale price index falling to 2.5%. I don't remember in the near past when that has happened. So I think in India, we are seeing a big sort of standing out as far as macroeconomic factors are concerned. And on the policy front itself, you have diesel prices which have been deregulated, you have gas prices which are long overdue as far as increase is concerned. And the biggest thing is the direct subsidy transfer or the direct benefit transfer. I think that can revolutionize a lot of things. And as we move forward, there are talks about a lot of things happening on the coal front, on the power front, on the railways front,
GST.
on the defense front, on GST front. So we definitely look in the near future as well as the medium term with a lot of optimism as far as policy decisions are concerned.
So, the note that we read, which is essentially what you guys are reading, and some of the other things that came out, I'll quote. one of the points is break your final target into a set of smaller target and milestones. I believe this is something that you've written now, or is something that you're reading. Yes. So now let's put this in context with how you relate to things generally and with regards to markets. I'll leave the option to you as to how do you want to choose. What is the milestone over the next 12 months, say for the markets or on the personal front, and how are you breaking into smaller targets?
See, very clearly, as you rightly said, you do have a longer term sort of thought process and long term vision as far as the market is concerned.
Right.
But obviously, you'll have to break it up into smaller targets. So I think
what is the vision and what are the targets?
Yeah. So in the immediate term, say in the next 6 months to 1 year, we would like to see some of the reforms which you mentioned continuing. So whether it's GST, whether it's spending on infrastructure, railways, we would definitely like to see that. I think somewhere down the line, we'll also like to see interest rates coming off. On the grassroots level, we have already seen interest rates on corporate deposits come off. Banks have started to reduce the FD rates. It's a matter of time before the RBI also acts. So that would be, you can say, a medium to near-term target. And somewhere in the next 1 year, we would like to see the sectors which are not firing in terms of growth and profitability, they also start to fire up. I think that would make this rally, that would make the growth in the economy a little bit more rounded and balanced. Right now we have one segment which is growing fast, but the other segment, which are the lag segments, which are still trailing, I think that would need to be seen in the next medium term.
And we are definitely coming to sectors as well with you. Yeah, can't do not do that with Sunil Singhania. But another thing that you guys are reading in that note is something that Heidi Roizen has quoted. She's saying that there is the great thing about being an entrepreneur, this is from your note of course, is that there is no safety net, no regular paycheck. You have to do it all on your own. And I think in your job, it's probably the same. There is no safety net. You don't really care for the paycheck. It's essentially about the kind of performance
Why did you say that?
No, I'm just saying that you essentially care more, I guess, about the performance that your fund puts up as well. How are you monitoring that? Because the global markets are volatile. We have our own issues as well. Tanvir was just telling me that domestic mutual funds exactly haven't had the best of inflows as well. So how is Sunil Singhania as that fund manager or the head as the CIO is managing all of that?
See, one thing is very clearly when you take an investment call, you have to take it from a perspective of where you are heading to at least in 3 to 5 years perspective. You can't take an investment call based on what is going to happen tomorrow or in the next 1 month. There are questions that whether you will now be defensive or whether you will like to be a little bit more aggressive, you will play beta, you will play pharma. I think near term, it makes sense, but that is for traders. When you take a call, I think the call from our perspective is whether the Sensex or the corporate earnings, the Sensex earnings, which are like 1340 for FY14, our view is that they can move up to 3,500 to 4,000 by 2020. And I think that is the big picture we are playing on. Now, in this big picture, there might be sporadic incidents where something might happen to Dubai, something might happen to Japan, something might happen to US, something might happen here in terms of rainfall being low, high, some political issues, some geopolitical issues. That you have to manage in terms of your risks. So I think overall, one, you need to know your goal from a longer term perspective. The goal is obviously India growing, India reaching a sort of a GDP of at least $4-5 trillion. The next goal is obviously investors making wealth, and then you come to your portfolio creation in terms of what you intend to do on a day-to-day basis. So I think from our perspective, it's not only me but my whole team. Obviously, wealth creation for investor is the preeminent thing. All other things are also important, but that becomes the most important sort of perspective.
Another point within that report is talking about eliminating doubt and bringing in team players. Now, the way I understand that is there is some bit of skepticism in the market still, split down the middle. The confidence is not across the board, especially in the last 6 months since the government has come to power. There is growing doubt in the market on whether they've met expectations, whether they could have done more, and the arguments there are going back and forth. How do you look at that? Because like Niraj said, the domestic inflow numbers have not been that encouraging. Even in terms of FII inflows, right? We've seen better years when the market has gone up. So how do you kind of rationalize your conviction in a market where confidence is not across the board, where there's still some doubt? How do you eliminate doubt?
So, we Indians are very interesting people, One, for the last 4-5 years, we had no confidence on the country. So we were very, very, sort of negative on our own country, and the foreigners kept on putting in money, and they basically bought everything which was available in terms of good quality stock. Now in the last 5 months, I think it's been only 5 months since the new government has come in place, we expect everything to be overturned, what has not happened in the last 5 months. I think it's a little bit unreasonable. So I think from our perspective, we would definitely like the government to give to be given some time. And I think it's already started to happen. A lot of things which have not happened for years are now happening. We can't have announcements on a daily basis. We need to build on 3 or 4 big things and do them properly, rather than try and do 20 things and not do them properly.
So do you think that the market is pretty much priced in the exuberance, the first phase of that excitement, and now it's wait and watch to see the real numbers, and then perhaps see another strong move up from here? We've done 25% this year.
So it's fair to say that from deep undervaluation, we have reached fair valuation, but we are nowhere the overvaluation or an exuberance zone. As you rightly said to begin with, that there is still circumspection as far as the market is concerned. People are still a little bit worried. People are still a little bit, cautious. I think that clearly shows that we are not into a sort of a bubble or an exuberant kind of strategy. We are not buying something at 100p, and we are getting concerned at 16p. I don't think any market anywhere in the world becomes a sort of an exuberant market or a bubble market at 16p. The other thing is, we are looking at P's based on the outlook as of today. Now, suppose if the capacity utilization moves up, suppose if the policy decisions are taken and government spending starts to happen, suppose if we get FDI in the sectors which have been opened up, I think the GDP can again go back to 7.5–8%. And that would mean that the corporate earnings, which are struggling at 12, 13, 14% for the last 4–5 years, can easily trend up to 20% plus. And I think that is when the big change happens. That is when the profitability of a lot of companies just go up. In fact, we have done a study between 2002 to 2008. Corporate profits went up by 3 times, but the markets went up by 6 times. And between 2008 to 2014, ex-IT and pharma, the earnings were flat and the markets were flat. I think from our perspective, we are looking at the earnings growing 3 times again between 2014 to 2020. And that is what we are banking on, and that is what we are playing for.
So what is your earnings estimate for FY15 and also your overall GDP estimate for this year?
So FY15 estimates for earnings are 1530–40. GDP is, we are still early days. So maybe, we might be growing at, say, 6% on an optimistic basis this year. But thereon, our earnings estimate is 20% plus for the next 5 years. And I think that leads to an earnings of almost between 3,500 to 4,000 by 2020.
All right, stay on Sunil. So much more to speak about. Lots of other facets to Sunil Singhania at his home or at his second home. And we'll talk about all of that on the other side of this break. Stay tuned. So Sunil, as we said in your first home or in your second home, let's try and nail it down to spaces as well. We can't do a conversation with Sunil Singhania and not have that. So this Samvaat to next Samvaat or the next 2 Samvaats, what to your mind stands out? There will be 2 or 3. Let's start off with your top favorite. As a sector, what stands out?
See, very clearly, we are working on the hypothesis that India's growth, which had slowed down significantly over the last 4–5 years, is going to come back on stream. So I think the sectors obviously have to be linked to that, which is the domestic growth. So, financials, good quality capital goods, engineering, I think that would be the obvious choices. Having said that, there are a lot of export-oriented sectors, and that again comes back to the Make in India, export focus kind of a theme, where even IT will do well, chemicals are doing well, pharma will do well, some engineering, auto ancillaries will do well. So I think the good thing is that we have good choices, but to be blunt and just focus on a couple of sectors, it might basically be the financials and the capital goods, but good quality.
What about infrastructure?
Infrastructure as a space is great, but companies in the infrastructure sector which are great, you can count them on your fingertips. So I think that is the dichotomy, So we don't want to get into companies which have stretched balance sheets. And because if you have a stretched balance sheets, howsoever big the opportunity in that sector is, you will not be able to make use of it.
You think with the oil reforms announced, the sector now gets re-rated?
I think last 2–3 months, except the upstream, the oil marketing companies were doing quite well. Having said that, I think this reforms definitely makes predicting earnings a little bit more easier. Because last so many years, earnings used to be dependent on what government wanted them to make. So I think to that extent, it makes it a little bit more, you can say, analytical in the terms of what they are going to make or not. Also, the working capital incident for a lot of these companies will come off.
Yeah.
But we have to also remember that once you deregulate a sector, then competition can come in. So how these companies will be able to brace whether
Which
all
is why you booked out of some of these companies. I believe last month you did book some profits there. So
that is
all of that is in the price? I mean, are the positives in the price is my question.
I think, see, analyze, or you can say the constant reshuffle in the portfolio is a strategy which as a fund manager you'll always try to do.
No, which is fine. So then is this in the price is my question to you. Simple question to you is, you were saying that it can be predicted now. So are the benefits in the price or are there much more?
I think the obvious news flow is in the price. But as I said, from here on now, we'll have to see what is the strategy of each individual company.
Okay.
And on the basis of that, you can take further calls.
But for upstream companies, Reliance, ONGC,
I think it's still a little bit, you can say, non-clear in the sense that what is the kind of subsidies they will still have to bear. So it's not that the subsidy has become zero. The subsidy on petrol and diesel has become zero. There is still a subsidy on cooking gas. There is still a subsidy on kerosene. How that subsidy gets adjusted is something which we still don't have clarity on.
Okay. What about domestic cyclicals? Do they make a comeback? I mean, a lot of people are talking about cement looking extremely buoyant from a 12-month, 24-month perspective. Some of the other sectors have already probably done well too. What do you like in this pocket, if at all?
See, very clearly, for the economy to grow to $2 trillion to $4 or $5 trillion, you'll have to do a lot of things. You'll have to build roads, you'll have to build houses, you have to build a lot of other infrastructure facilities. If you have to do something about Swachh Bharat, you'll have to spend 1 lakh, 2 lakh crores. You have to do something about the railways, you have to spend money. All these impact the domestic cyclicals, and cement obviously is a key, component of that. And the other thing about the cement companies is that you already have the capacities. You're not utilizing the capacity to the fullest. So your interest and depreciation has already been provided for. Every incremental increase in capacity utilization just flows to the bottom line. So another key theme which we as a fund house are playing is companies which have capacities which are not being used to the fullest. So the moment those capacity utilization starts to go up, the profit jump will be much higher. And I think that is where a lot of these domestic cyclicals will fit in.
What about true blue defensives? Strangely, consumer staples have done really well. And if a part of this growth story is consumption linked, and if those growth numbers are going to pick up from here, then one should not be surprised for the rally that some of these consumer staples have shown. Discretionary, of course, because there was a price favor there, but the staple side.
I think consumer staples in India definitely has a lot of potential to grow. We have 1.2 billion people, as you said initially, the dividend of demographics is still to flow in. At the same time, from our side, we would not give a 40 or a 50 PE to a company which is growing at 5% or 7%. You take the example of IT. A slight reduction in volume growth just decimates the stock. The same thing does not happen in a consumer staple company. I don't know why. So I think from our side, we are sticking to consumer staple companies where the growth is higher. So alcohol companies, we are more bullish than say a shampoo company or some other company. Homegrown brands, whether they are in sanitary ware, they are in textile, they are in shoes, they are in XYZ, we are very positive. Obviously, the number of shares or the size of the companies is still limited, but that is one theme we definitely can play. Urban consumption is a theme which we like. So last 4-5 years was a time for rural consumption growth. I think the next 4-5 years, maybe urban consumption can come back. So organized retail, e-commerce, these are some urban consumption themes. There we are positive on. So I think we would say that instead of just playing the you can say the traditional consumer staples, these are the new consumer-facing businesses, which we would be positive on.
For a fund, Sunil, how do you play e-commerce? There's hardly anything which is very liquid available. There are ancillaries like logistics, for example, which are probably there. How do you as a fund manager look at the companies and say, okay, hey, this looks nice and it's liquid enough for me to buy?
So there are a few companies where we have invested. At the same time, see, even if you don't have investment opportunities now, you have to track the sector. Because it's a matter of time before more and more companies will start getting listed. So the way in IT, it started as 1 or 2 companies and now you have such a big choice. Or with telecom, there was only 1 company and now you have 6-7 listed companies. I think the same thing would happen even on the e-commerce space.
Okay. What about the ancillaries? I mean, logistics is one, but
The opportunity is huge.
Is
I
huge.
think what we have to see is which companies are best positioned to capture that opportunity and what are the valuations which you are paying for.
but without getting into names, does the listed space have these opportunities
I think
available?
this segment is going to be huge. There's no
It's
doubt
going to
about
be
it.
huge, okay.
So I think you just can't ignore it.
Okay.
Okay, talking about IT and pharma, now we've seen a bit of a change in allocation as far as pecking orders goes for IT, right? With the current earnings coming in, Infosys talking about their outlook. So your view on IT, have you kind of shifted your stance company-wise? You won't be able to name stocks, but your broad view on IT and pharma with the US FDA, putting a lot of the companies under its scanner. What's the view?
See, on IT, very clearly our view is positive. That does not mean that we are very, very significantly overweight, but we would not like to be underweight. And the call is very clear. After a long, long time, except one company, most of the IT companies are trading below Nifty PE multiples. I think that's happened after a long, long time. And IT as a sector keeps on growing in terms of absolute profit, upwards of 15-20%. People get, as I said earlier, they get a little bit hassled with 0.5% reduction in volume growth. Cigarettes has not been showing any volume growth, but the company still trades at 20 PE, because there you are looking at the absolute profit growth. Why not in IT companies? All the other thing is that if the world is going to be stable, the demand for IT is going to be stable. And once you move toward the digitalization, the SMAC and social mobility and e-commerce, the incident of use of IT is only going to increase. So I think it's a great sector. Indian companies are very good in terms of corporate governance, very good in their skill set. They are now very large companies, having almost every large company as their client. So I think it's a great sector to be in. And we would be positive IT. On pharma, in fact, our overweight is maybe the highest. So instead of consumer staples, the underweight in consumer staples, we are sort of making up with an overweight on pharma.
You haven't booked up?
No, we continue to be positive, and there the profit growth again has been upwards of 20-25%. Companies from India are now sizable companies. They can basically compete with the biggest in the world. In fact, some of the companies are now among the top 4-5 companies in the world. The other thing is that domestic pharma also presents a big opportunity. So, we always talk about consumer staples or consumer, sort of sectors where India has a lot of potential because of the huge population. But if you look at pharma, the total size of pharma market in India is only $13 billion. One drug of Pfizer, Lipitor, before it went off patent, was more than that.
But regulatory overhang? No, that doesn't bother you.
See, that will
because
always...
they've gotten a bit more active in India now.
That will be the case everywhere. The regulatory overhang in terms of genericization has been there in the US, in Europe, in Japan, because you also want to, sort of match the affordability with thing. I think we have to live with it, that we can't have a scenario where just for the sake of high profitability, 95% of the population gets impacted. So you'll have to match that, and we are a poor country, we'll have to adjust it properly. But even despite that, companies are generating about 25% ROE. They've been growing at 20%, so you don't have any complaint as an investor.
Okay, stay on, Sunil. We are at Sunil Singhania's second home. We will take Sunil Singhania to do what he likes doing outside of home.
All right, Sunil, we'll do a quick rapid fire now. So, no time to think, but just answer the questions that we shoot off.
Sure.
First one, Nifty levels, same time next year, above 8,500 or around 7,500?
I would go for the higher one,
Above 8,500.
above 85.
The most bullish sector.
Private banks,
Okay, the risk for the market.
global financial meltdown.
What would you avoid?
I think regulated sectors.
What would be a clear outperformer? One sector that will clearly outperform.
I think homegrown brands, small sector, but can do very well.
Favorite Bollywood actress?
Deepika Padukone.
Okay, I'm glad she got it out. Great. Sunil
I hope she watches it.
Well, we hope so too. We want TRPs too. But Sunil Singhania, it's been fabulous with you at home, at your second home, out here where you spent some of your time as well, and bursting the crackers in the backdrop too.
Thank you for having me.
Thank you so much for joining us on At Home with Sunil Singhania.
Thank
Really
you.
good having you.
Thank you,
Wishing you a
Niraj.
very happy Diwali.
Same to you,
All
Tanvir.
the best.
Thanks, and wish happy Diwali to all the viewers at ET Now from Reliance Mutual Fund.
Thank you so much, Sunil. Thanks so much.
Thank you.
Find us on Facebook at facebook.com/etnow and don't forget to click the like button. You can also follow us on Twitter at etnowlive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/etnow.